MC Laubscher here. I'm the Chief Cash Flow Engineer at Producers Wealth. And in this presentation, I'm going to share more information regarding a life insurance line of credit and how to set up different types of life insurance lines of credit. But first, let's review the Aligned Capital strategy. This is the strategy that we at Producers Wealth help our clients implement and execute. The Aligned Capital strategy consists out of 5 pillars. The first pillar is capital creation. We all have to produce and create capital in some capacity, whether it be as an employee, whether it be as a self-employed person, whether it be as a business owner or as an investor. Once we've produced and created capital, we have to position it somewhere to protect it. And this is the second pillar that we call capital capture, because we're trying to capture all the capital which we produced and created. Once we've produced and created this capital, we position it effectively and efficiently in vehicles and assets, which we can leverage by establishing lines of credit against it, to then deploy more capital into pillar number 3, which is cash flow creation, where we acquire with this capital more businesses and real estate that pays us to own and hold these assets. Under the 4th pillar, which is capital growth, we can also position capital in asymmetric investment opportunities. Under the final pillar called capital control, we protect everything that we've produced and created, that we've positioned, and that we've deployed and acquired with proper tax strategy, proper asset protection, and proper estate planning. Here's a closer look at what happens under capital capture. Once we've produced and created capital, we then position it in a life insurance policy, a dividend-paying whole life insurance policy with a mutual insurance company structured specifically for early cash value growth. Some folks have referred to it as a high cash value life insurance policy. We also call it the producer's capital account, because this is where our producers position capital effectively and efficiently. Why? Well, it's a private contract between the life insurance company and the client. It is also a vehicle that guarantees the capital which you position in there. There's also guaranteed growth in the policy. And as a policyholder, you're a shareholder in a mutual insurance company, so you get to participate in the profitability of the life insurance carrier through dividends. And the carrier that we use have paid dividends every single year consecutively since the 1850s. So there's a very long track record of dividends that are paid out every single year. The growth and the dividends accumulate and compound tax-free in the policy. And because it's a life insurance policy, there's also a death benefit that will eventually go tax-free to the client's beneficiaries, whether it be a spouse, children, or a trust. Now, once the capital is positioned effectively and efficiently in this policy, you can use the cash value as collateral to get a line of credit established with. And once you set up this line of credit, you can access the capital through a loan. That's why it's also tax-free, to then use it to either grow your existing business, acquire another business, or invest in real estate. These assets which you own pays you to hold them and produces cash flow. The cash flow of the business that you've grown, or the newly acquired business, or the real estate that you've purchased is used to then pay down the line of credit. And any windfalls of capital that you come into, whether it be your personal, your business, and or your investment economy can then also be used to pay down this line of credit because it's a revolving line of credit. You don't have to pay off one loan before you can access another loan. It's a revolving line of credit, very similar to a home equity line of credit. Now let's take a look at the life insurance line of credit. And the first type of line of credit that I'm going to be sharing is a line of credit directly from a life insurance carrier. This line of credit directly from a life insurance carrier has also been referred to as a policy loan. When we establish a life insurance line of credit with a life insurance carrier, also known as a policy loan, there's a couple of things that you should be aware of. A couple of things that are very important to know when you are setting up a life insurance line of credit directly with a life insurance carrier, also known as a policy loan. Once you've executed the life insurance policy, and by executing the life insurance policy, I mean you've signed the final paperwork and you have paid the premiums of the policy is then in force. And once that happens, 30 days from executing that life insurance policy, you can apply for a policy loan. So within 30 days, you can apply for a policy loan and you can have access to your funds. You also have guaranteed access to your funds. This is very important to note. The life insurance carrier guarantees the policyholder access to their funds, regardless of what is happening in the economy and in the financial markets. When it comes to the interest that is paid on the policy loan, it's very important to understand that the interest is simple interest and it is a variable rate that can change annually, and it's based on the Moody's Corporate Bond Average Yield. The Moody's Corporate Bond Average Yield is not volatile. There isn't massive spikes up or massive drops down. It's just been a pretty stable baseline, which life insurance carriers have used to determine the rate of interest that they charge on the policy loans. There's also no minimum to apply for a policy loan. If you wanted a policy loan for an emergency of $5,000 or $10,000, you can apply for a policy loan and you can access that $5,000 or that $10,000 through a policy loan. The loan to value is usually around 90%. So what that means is usually a life insurance carrier will give you a policy loan for approximately 90% of the cash value that you've established in the policy. For clients with multiple policies, and we have a number of them, we have a number of clients that have implemented and executed the family banking strategy. So when you have multiple policies, and sometimes families have up to 10 life insurance policies inside of their family bank, it's important to note that you are going to have to apply for a separate policy loan with each policy. So you cannot combine all of the life insurance policies and combine all the cash value inside of the life insurance policies and set up one policy loan for all of the policies. There's also no credit term when you set up a life insurance policy loan. What's nice about a policy loan is there's really no credit term. So when you apply for a policy loan and the policy loan is funded, usually the interest that is charged, based on simple interest, is charged for the following 12 months. So if you get a policy loan for $100,000, and let's just say the interest rate is 4%, then using the simple interest approach, that means that $4,000 of interest will be owed for the next 12 months. So you are in complete control of your cash flow. You're literally your own bank because you determine the payback schedule and the payback period. You can either pay back that $100,000 in 12 months, which in that case, you would have paid back the $100,000 plus the $4,000 of interest. If you pay it back in 6 months, then you would have paid back the $100,000 and only $2,000 in interest. Now, when you are in a situation when you don't pay back that $100,000 in the following 12 months, and let's just say you didn't pay any principal back, what will happen is the $100,000 will then carry over, and the $4,000 of interest, which in this example you also didn't pay, will just roll into the loan. Something that is very important also to know about a policy loan with a life insurance carrier is you don't have to ever pay back this loan. They have your cash value as collateral and also your death benefit. So the insurance carrier is covered twice. But in our strategy, we position capital in a life insurance policy. We set up a credit line using the cash value in the life insurance policy as collateral. And in this case, you can access it through a policy loan directly from the insurance carrier. And then you go in and grow your current business, acquire another business, or buy an asset like real estate that produces cash flow, and then the cash flow from these businesses or the real estate and or other investments then pays back the policy loan and any other windfall which you get in your personal business and investing economy is used then to pay down this policy loan. So we want to be an honest banker here, and we want to manage our cash flows properly through the strategy, and we want to pay back this policy loan because this is now the primary place where we warehouse capital. We warehouse capital as producers in the producer's capital account. There's no credit check done when you apply for a policy loan. So there's no public record or a database which your information is entered that third parties can then find that information on you when you apply for a policy loan. There's also no fees for setting up a policy loan. You're being charged interest when the policy loan is funded. I've already covered flexible payments. This really sets you in full control, managing the cash flow in your personal business and investing economy. So it's extremely, extremely flexible. You are literally your own banker when you have a policy loan from a life insurance carrier. The interest can be tax deductible. You're going to have to do some proper planning and have a strategy that you will implement and execute with a tax strategist or a tax advisor or a CPA. You do not receive a checkbook when you get a policy loan directly from a life insurance carrier. When you set up a life insurance line of credit directly with a life insurance carrier, also known as a policy loan, it is very, very important to understand the different approaches that life insurance carriers follow when it comes to policy loans. There are two different approaches used by life insurance carriers. They're called a direct recognition and a non-direct recognition approach. Full disclaimer, I have both a non-direct and direct recognition policy. And in this segment, I'm going to share with you why, from a big picture perspective, the non-direct versus a direct recognition debate really doesn't matter. Now, when you access the cash value of your overfunded life insurance policy through a policy loan, you do not take money directly from your policy, and you do not directly access the cash value. The cash value is collateral for the policy loan that you receive from the insurance carrier. The policy loan comes from the general account of the insurance carrier, and it is a separate transaction. You do not borrow money from your cash value. I just want to state that again. You don't borrow your own money and pay interest on it. I've seen this comment over and over again out on the internet. it's not your money. It's a policy loan that you receive by placing your cash value as collateral. It's the insurance company's money that they could have actually used as part of their portfolio and invested somewhere to get a return. But they use that to give you a policy loan. So the insurance company charge a rate that they could have earned on the money, and conservatively, most of them use the Moody's corporate bond average yield rate as a measurement. So it's currently around 5%, and it is a variable rate. With mutual insurance companies, you get non-direct recognition and direct recognition carriers. Non-direct recognition carriers does not adjust the dividends paid on a policy when there is an outstanding policy loan. Direct recognition carriers does adjust the dividends paid on a policy when there is an outstanding policy loan. They would pay a lower dividend on the outstanding loan amount. It sounds pretty simple then that non-direct recognition companies are the ones that you want to use when you plan to use the policy as your own family or business bank and take policy loans consistently, right? The answer is no. There are no deals in insurance. I just want to repeat that again. There's no deals in insurance. It's all math. What you take from one area, you need to make up in another area. There's no magic well for non-direct recognition companies. Non-direct recognition companies have been criticized, by the way, that policy holders that do not take loans subsidize the policies of policyholders that do. Here's the reality. This is all smoke and mirrors. It's all sales pitches and marketing. Just as salespeople argue about which mutual insurance company is best, this debate is as close to that as you'll get. You get good and bad direct and non-direct companies. You get good and bad direct and non-direct policies. You get great, good, average, and bad insurance agents promoting it. The Blees Research Group produced a Blees Projected Income Report comparing non-direct and direct recognition companies and whole life insurance policies. So if non-direct recognition were the ultimate feature, then the non-direct recognition companies in this independent study should consistently report higher incomes, right, than their direct recognition counterparts. But it's not the case. The top performer actually was a direct recognition company, and the runner-up was a non-direct recognition company. And by the way, the top performance in this report, most of them are direct recognition companies. So direct recognition and non-direct recognition have many pitfalls, and both policies can fail, by the way. Why? It's how you use it. The strategy and behavior of the policy holder determines the success of the contract and the policy. You can have the best and most well-designed high cash value life insurance policy, but if you really treat and manage that contract insufficiently, then it's not going to do what you want it to do. If you're going to be a dishonest banker in your family bank or business bank, your policy will not do what you want it to do. So let's take a look at a quick case study of a non-direct recognition policy illustration versus a direct recognition policy illustration. And for this case study, we're going to use a female that's 45 years old. She is a non-smoker and she has a preferred rating, and she's going to be funding a policy with $32,531 for 10 years and then completely pay up this policy in 10 years. So let's take a look at the non-direct recognition policy illustration first. So we'll see that in this illustration that she's funded the policy for 10 years, $32,531, and then it's completely paid up by year 10. Now in year 11, the dividend that she will receive on this policy is $7,651. That's $7,651. Now, what if she took a policy loan in year 11 of $350,000 using her cash value as collateral? How does that change the dividend allocation in this non-direct recognition example? Well, she's still going to be receiving $7,651. In year 12, she's going to receive $8,167. In year 13, she's going to be receiving $8,702. Year 14 is $9,265. And in year 15, it's $9,838. So let's take a look at a direct recognition policy with the exact same assumptions. So she's going to be funding this policy with $32,531 for 10 years, and then the policy is going to be completely paid up after 10 years. In year 11, she's going to be taking a policy loan of $350,000 with her cash value as collateral. So what do the dividends look like for this policy? In year 11, it's $7,677. In year 12, it's $8,188. In year 13, it's $8,715. In year 14, it's $9,271. And in year 15, it's $9,856. So looking at these two different policy designs and policy illustrations of a non-direct recognition carrier versus a direct recognition carrier, you can see that there's a lot of smoke and mirrors here involved. And if you really take a big picture view of it, there's really not much difference in the big picture and overall performance of this and the dividend payouts. I would just like to state again that it all comes back to the individual of how you actually use your policy that will determine the performance of the policy and the performance of your overall strategy. For clients that are still struggling with the direct versus the non-direct recognition mindset, or for clients that want to maximize the dividends that they received and also be able to leverage the capital in their life insurance policies to grow their businesses, acquire more businesses, and or other investments such as real estate, there is a solution. And this is when you set up a life insurance line of credit with a third party, like a banking institution and or a financial institution. Let's take a look at a line of credit from a banking institution. A couple of things that are very important to understand when you are setting up a life insurance line of credit with a banking institution. You can only establish a life insurance line of credit after your life insurance policy has been in force for 12 months. You also are not guaranteed access to your funds. So a bank, which you have set up your life insurance line of credit with, can decide, based on what's happening in the economy or in the financial markets, that they're just no longer going to honor your existing life insurance line of credit, and they can pull it, or they can just decide that they're no longer offering a life insurance line of credit for prospective clients because of what's going on in the economy and the financial markets. There's also a variable rate used, the market rate, when the interest is calculated. So this can change at any given point in time. And this also, of course, is dependent on what is happening in the economy and in financial markets. So you're going to get the market rate when you set up a life insurance line of credit with a banking institution, and it is variable. There's also a minimum line that you have to set up with a life insurance line of credit. Usually around about $65,000 is the minimum. Some banks also have a minimum of $100,000. Most of the banks will give you a line of credit of about 95% of the cash value that you have in your life insurance policy. We also have a resource, a bank which clients in our network use, that will give you a line of credit of 100% of your cash value. When it comes to multiple policies and managing multiple policies, and there's a lot of our clients that have multiple policies as part of their family bank. What a banking institution will offer is a banking institution will actually combine all the life insurance policies in your family bank and the cash value inside of these life insurance policies, and they will give you one line of credit using the cash value in all of the policies in your family bank as collateral. Now, this is, of course, great from a management standpoint when you are managing, in some cases, 10 policies or more as part of your family bank. So instead of having to establish a line of credit separately for each policy, you can combine the policies and combine the cash value in these policies and set up one line of credit. Normally, the term on a life insurance line of credit with a banking institution can be around 2 years, and it may require a credit check in certain situations. There's no fees for setting up a life insurance line of credit with a banking institution. You only start paying the interest once you start using it. They also offer flexible payment options. In some cases, you only have to pay the interest, and the interest can be tax deductible. Again, you would need to do some proper planning and have a strategy that you will be implementing and executing with the help of a tax strategist, a tax advisor, or a CPA. A life insurance line of credit with a banking institution does come with a checkbook. And this is, of course, a great convenience and why a lot of our clients have a life insurance line of credit established with a banking institution, because they can literally write a check when they need access to capital. Let's take a look at a line of credit from a financial institution. There are a couple of things that are very important to note when you are looking at establishing a life insurance line of credit with a financial institution. You can only establish a life insurance line of credit with a financial institution after the policy has been in force for 12 months or more. You also don't have guaranteed access to your funds. A financial institution, the same as a banking institution, can take a look at the economy and financial markets and decide that they're no longer going to honor a life insurance line of credit for existing clients, and also they are no longer going to offer a life insurance line of credit for new potential clients. The interest rate on a life insurance line of credit with a financial institution is also a variable rate. So it's based on what is happening in the market, and it is variable. So there could be changes while you have this life insurance line of credit established with a financial institution as the environment, and more specifically, the interest rate environment changes. There's a minimum of $65,000 of setting up this life insurance line of credit with a financial institution. A financial institution will usually let you establish a life insurance line of credit for up to 95% of the cash value that you have in the life insurance policy. And similar to a banking institution, a financial institution will allow you to combine the life insurance policies in your family bank and the cash value inside of these policies, and they will allow you to place the cash value in all of the policies as collateral for one credit line. So a family bank becomes much easier to manage with one credit line than having multiple credit lines with multiple policies. The term is usually going to be about 1 to 2 years. There's different periods with different financial institutions. There's also generally no credit check required to establish a life insurance line of credit with a financial institution. There's also no fees for establishing this line of credit. You'll only start to be charged interest. You will only be charged interest once you start using the line of credit. There's also flexible payments available, and in some cases, only the interest is required to be paid, and this interest can be tax deductible. Again, you will have to do some proper planning and have a strategy that you will implement and execute with the help of a tax strategist, a tax advisor, or a CPA. And you also do not receive a checkbook when you set up a life insurance line of credit with a financial institution. So here are some things to consider when you are looking to choose a credit line resource. How soon do you want to establish and set up a life insurance line of credit? Do you want to do it in 30 days? Well, then you have to do it directly from a life insurance carrier. Can you wait 12 months for a life insurance policy to be enforced? Because then you can use a bank or a financial institution. How important is guaranteed access to your funds for you? In great economic booms, a third-party resource such as a banking or a financial institution might be great, but when the economy is in a recession or a depression and financial markets is extremely volatile and full of fear and panic, it might be better to just have guaranteed access directly from a life insurance carrier when you need it. How important are the terms of the life insurance line of credit? There are certain terms that a life insurance carrier have that banking and financial institutions don't. And there might be certain terms that a banking and a financial institution have that a life insurance carrier does not have. Obviously, a policy loan directly from a life insurance carrier provides the most flexible terms. How important is the direct versus the non-direct recognition approach for you? There are some of our clients that this is not that big of a deal, and then there are some of our clients that cannot get over the direct versus non-direct recognition mindset. They want to maximize the dividends that they're awarded, and they also want to use their capital to grow their businesses and acquire more assets like businesses and real estate. So for those clients, they can have the best of both worlds when they set up their life insurance policies with a direct recognition and then also use a third-party resource when establishing a life insurance line of credit. How important is the loan to value for you in determining how to choose a credit line resource? There are some of our clients that are okay with setting up a life insurance line of credit, which allows them to access up to 90% of the cash value that they have in their life insurance policies. There are other clients that want the best LTV possible and even have access to 100% of the cash value that is in their life insurance policy. How important is the interest rate? Is the lowest possible interest rate important for you? Is it important to lock in one specific interest rate at least for 12 months before it changes again? Or are you okay to have a variable interest rate which could change monthly, as it can when you set up a life insurance line of credit directly from a banking or a financial institution? How important is checkbook access? This is a very, very important point when it comes to deciding how to choose a credit line resource. When you apply for a policy loan from a life insurance company, in some cases it could take 3 to 5 days when you have a check mailed to you, or it could take 48 to 72 hours when you have funds wired directly from the insurance company to your bank account. With a checkbook, what you will have access to through a life insurance line of credit directly from a banking institution, you can literally write a check when you need the funds. This is important for some of our clients. And then finally, when it comes to your family bank strategy and having multiple policies, there are a lot of our clients that just want a very simplified process in place for managing their family bank. So when you set up a life insurance line of credit with a banking or financial institution, they allow you to combine the family bank policies and the cash value in these policies, and they allow you to place the combined cash value as collateral for a life insurance line of credit. So you only have to manage one single line of credit. When you have a family bank with 10 plus policies and you are applying for policy loans directly from a life insurance carrier, you have to apply for a policy loan separately for each policy. So it could become a nightmare to manage your family bank depending on how many life insurance policies are inside that family bank. I hope you found this presentation valuable. If you have any questions regarding a life insurance line of credit, please contact myself and my team at team@producerswealth.com. That's team@producerswealth.com.